Very good. So let me share my screen. I do have slides, unbelievably. Let me find where that is, and we'll get going. All right. Can everyone see this monster? Is it clear? Big?
Yes.
Very good. All right, good. So anyway, these were the topics of the year, for the year, and as you can see, we've covered quite a myriad of items. We are going to talk today about, most of our meetings have, as you can see, have been pretty much recruiting people into the fractional issue because we do believe it's the best career choice you could possibly make, and also how-tos. But today we're going to talk about how to expand your business and how maybe to change your business from the business, from the trap of time for money and maybe starting your own firm, or we're going to talk about some other options. And of course, this may not be for everyone. I mean, some people are, you're perfectly happy, you've established yourself, you've got a nice client base, and you're not ready to do this or look to grow. And maybe you're just not, it's maybe timing, it may just be your desire. I mean, you're making good money, you're enjoying yourself, but we hope that by listening to these stories and examples, it may give you some ideas as to how to expand your business in the future. Brad, introduce yourself, and then we'll get to your story in just a few minutes.
Well, I appreciate it, Mark and Brendan, and just what a great group of people. I mean, this is kind of an all-star team of people when you listen to your backgrounds and such. So, and I'll get into the story a little bit more, but when I jump in, but I started Focus CFO in 2001, and I'll Mark, do you want me to go into, you want me to kind of take it from here, or do you have other things you want to cover after?
I think let's just go into this. Yes, that'll be good. Now, the best thing I want to share just one part of the story before, or one piece of information I find really interesting about Brad's story, and I'm sure he'll share this, but I find it amazing. Brad has never provided fractional CFO services himself. He knew what he wanted to do, and he created a firm. It makes a great, he's going to share his story and, the pros and cons and some of the challenges and some of the wonderful things that he's accomplished. So, Brad, why don't you take it from here? It'll be great.
That'd be great. So would you go ahead and take down the slide so I can see everybody? Or stop sharing the screen, and
yes, we can do that.
That would be helpful since we don't have any more slides.
Brendan, are you there? Hold on.
Yep. Yeah, I'll see if I can actually get it to cooperate now.
You did it before for me.
I'm doing it now.
Good. All right.
There you go.
There we are.
There we go. That's much better than staring at a screen that says Brad Martyn's story. So, but anyway, this is a great group. There's 20 some people, I think, on the call. And just as I had a chance to hear some of your stories, a lot of what your backgrounds are similar to mine. A lot of your backgrounds are actually much stronger than mine as it relates to being a CFO and having that industry experience. And what I'm going to do is I'm just going to spend some time and I want to kind of tell you where I came from, and then talk about what it was like, why I started Focus, or why I wanted to be we actually called it part-time CFO back then. Fractional didn't really come into vogue until a few years ago, and kind of what it was like for me getting started, and then what happened as we started this scale. And I'll just be really honest about what was good and what was bad, and some of the mistakes I made, and some of the luck that I had along the way. But so today I'm 62 years old, and when my undergraduate degree is in accounting, I went to work for Arthur Andersen in 1983, back when it was a good firm. And I went into I was in audit for like 6 months. I hated it. I went into tax because I thought I would like it. It turned out I didn't like either one. But I was a pretty decent tax guy for only having been there for 3 years. And then I went into industry. And I actually spent 15 years with two companies that were each about $60 million. And I live in Columbus, Ohio, so right in the center of the state. Um, I worked really for two companies, not really growing up in the accounting side, but growing up kind of in the treasury and finance and operations side. So I was a corporate tax guy when I started, but I got heavily involved in working with investment bankers, and we did a public offering at each company. So I was involved in that. I turned into a pretty good FP&A guy. Never a really good general ledger person at all. But I had the chance in both of the organizations I was with to get really involved in both the operating side and the acquisition side. And so the last company I was with, the last public company I was with, we went out and raised whatever 50 or 60 or 70 million dollars, and our revenue was about 70 million at the time, and we started doing acquisitions. And so I was the guy that got handed the ball and to go out and find small businesses that we could integrate into our existing business. So in the course of about 24 months, we did 17 acquisitions, and I happened to be the one. And these were small companies; they were $2 to $20 million businesses that we were buying them. And we were buying them so we could cross-sell our services into their customer base and their products and services into ours. And so as I'm the individual, so I'm in my late 30s at the time. So as I'm the individual that was out meeting with these business owners, doing due diligence, we would put the deal together, and then I would work with them on integration. So we were a public company, but I didn't do any of the real public company stuff. I was really like the internal CFO as opposed to the external CFO. And some of you can probably relate to that with some of the things that you had done. But as we're doing these acquisitions, I was really transparent with, and they were all first generation entrepreneurs that started their business. And none of them had ever had a CFO. They all had a CPA. They all had a controller. They might have had somebody called CFO, but they really weren't doing CFO stuff. They were really doing accounting and closing the books and stuff like that. But as I'd meet with these business owners, I was really transparent with them about, hey, this is what it's going to be like, and we're going to give you X number of dollars. You're going to have to work with the company for 3 years, and a lot of you can probably relate to transactions like this. You're going to have to work with us for 3 years. You're going to have to join a public company, and oh, by the way, P.S., we're going to kill your culture, because you're going to go from being entrepreneurial, seat of the pants, you can do whatever you want, to having to come into an organization that's very disciplined. We run around quarterly forecasts. We're very transparent with the street, but you're going to have to do that, and that's going to be your life. And they would all say the same thing. Oh, I always wanted to work for a big company, and I always wanted to work for a public company. And some of you are smiling because you've heard this before, but they and I said, look, it's not going to be like you think it's going to be. So anyway, they would do the deal, and we had an earn-out with them, so they had to work with us. And we're 6-8 months in to a lot of these transactions, and again, I'm working on integration, and I'm helping them assimilate to a public company. And one by one, they'd call me into their office and, hey, Brad, you're right. I really don't like this. This is not what I thought it was going to be. I should have listened to you. And a couple of them actually said to me, because I knew them really well at this point, and I was really good friends with them. They said, if I could have worked with someone like you, I wouldn't have sold my company. And it wasn't me, it was us. It was what everybody on this call knows how to do. And that was to take the financial aspects of running a business and to do it very well, very professionally, and to allow the sales and operations people to do what they do best. But when you're a first generation or when you're an entrepreneur running a business, you're wearing all of the hats. And as you know, you might have started the business because you were passionate about sales or customers or operations or product development or something. And that was your passion. But the running of the business begins to consume these entrepreneurs. And that was the dynamic I saw over and over and over. And that's kind of where the seed was planted with me. Now, I actually left that job in 2000 because I had 5 little kids at home and I was tired of traveling all the time. And I told my wife I wanted to go to work for a regular company and just kind of work 8 to 5. And she laughed at me, but I took a job as a CFO of a $20 million manufacturing company and privately held company, entrepreneur still owned 100%. And while I was there, after about 3 months, I was bored out of my mind. So this is going from a complex corporate environment like a lot of you have worked in into a very simple, small business, no board, no external reporting, no real growth strategy other than to grind it out. After 3 months, I was bored. And I actually quit. At 9 months, I quit. And I told my wife, I actually called her and just said, "Hey, honey, guess what I just did?" And I can hear 5 little kids screaming in the background. And I said, "Hey, I just quit my job. I'm going to start this part-time CFO thing." So that's probably not the best way to do it, but that's the way I did it. And what a lot of people I know that want to do this is they probably do more. Maybe they do some side projects or something while they're working full time if your employer will allow you to do that, or maybe they phase from 5 days a week to 4 days a week to 3 days a week with their existing employer. That's a strategy that we see a lot. And then they'll try to pick up a client or two. So that's kind of an easier transition. Mine was a hard stop. It's like I just quit and jumped off the cliff. Now,
You burned the ships.
I did. I burnt the ships, and there wasn't any turning back. And the day I quit was September 10th, 2001. So it's really easy to remember when all that happened. But here's what was interesting, and so maybe that background will help you because look, I was not a salesperson. I had never been trained in sales. I didn't know anything about business development. I always liked marketing, and I was intrigued by it. But I was a financial person that could relate to operations, that liked marketing, that had no sales experience at all. So when I quit, I had bought this database in Columbus where I live, and it was an old Dun and Bradstreet Excel database. And it had every business in Central Ohio, starting at the very top, which was a limited corporation, which some of you have heard, which is 6 billion or whatever, all the way down. It was every company with a headquarters in Central Ohio. And I remember taking that list, and I took every company between 20 and 100 million. And there were 730. And I don't know if that seemed like a lot to anybody else. It didn't seem like a lot to me, but there were 730 companies. And I went around, this is as I'm doing my due diligence. So if you're thinking about doing this, I'd recommend something like this to you. I had a list, again, 20 to $100 million, and I took it around and I started to show it to my CPA buddies. And I said, this is what I want to do. I want to start this CFO company. That's what I called it, a CFO company. And most of the CPAs that I talked to didn't really know what that meant because they couldn't differentiate what a CPA did from what a CFO did. So you may find that dynamic as you're out talking to people. And so they really couldn't relate to it. So as I showed them the list, they would say, well, these are the same companies that we're trying to work with. We don't really think we could partner with you on them. And I tried to explain to them that what we did as CFOs was different than what they did as CPAs, but I couldn't find a connection there at all. So I went to my banker friends And I showed them the list. And a lot of them said, oh, yeah, we know some of these companies, but a lot of them have full-time CFOs already. So I went home and I was kind of hangdog about it because I thought I'd be able to do something in that space. But I went to the the under $20 million space. And in that same database, I found 26,000 companies. So 20 million and up was 700, 20 million and below was 26,000. And I began to talk to people about that type of target market. And most of the folks that I talked to said, we can't make any money off of them. We don't really want to serve them. The entrepreneurs are too hard to reach. And we just don't like to play there. So that's where I decided to go, was into this under $20 million revenue size. Now, again, just as I'm just talking about these things, I just kind of invite you to think about kind of your market and what you know about it and some of the contacts you have, because if you're thinking about starting a fractional practice, or if you've already started one, what people generally find is the best way to access the client is not so much to cold call them, but to network with other professionals that service those and try to have a win-win proposition. And that's what I was able to do, because as I took that list of $20 million revenue companies into the banks, which is where I built the business around, was the banks, I found, at least here in Ohio, and I know this is the case because we're in 11 or 12 states now and we see it everywhere, but most banks have a group. I was familiar with commercial lending because that's where we had put all of our deals together. And I worked with all the commercial lenders prior to Focus. That's all I knew. I knew about commercial lending. I knew about branches. But I found out that most of the banks have specialized groups, particularly the regional banks, that focus on what they call here business banking. Sometimes it's under 50 million, sometimes it's under 20 million, but it's usually they're too big to go to a branch. So it's like 2 million to 20 million or 2 million to 30 million. So that's where I went. And so in November of 2001, I weaseled my way into what's called a business banking group at one of the regional banks based here in Ohio. It's called Huntington Bank. And there were 20 bankers in the room, and each one of them had about 100 clients. So I found what I call, when I used to fish, my grandpa would always talk about finding the honey hole. It's the place in the creek or the pond where the fish are. So I thought I had found my honey hole because there were 20 people in the room that each had 100 clients. And I figured if I can develop a relationship with each one of those, and if I could get introduced to one or two of each of their clients, I might have a chance of having a handful of clients. Now, I'm going to pause there. So any questions about kind of what I've talked about so far? Because I really want to get into execution here, but I wanted to give you my background. I wanted to tell you kind of what I saw when I did a little bit of market due diligence and what I found when I figured out how I was going to try to address the market, which was through the banks. Any questions so far?
Brad, this is Jim Lawrence. I'm just
Yes,
curious,
sir.
how would you contrast that with the layout, the lay of the land today?
It's actually, Jim, it's a great question. It's actually pretty similar. The one difference that we're finding, we still find that the CPAs are hard. They're hard. A lot of them just can't relate to what a CFO does. The tax ones can be good. The audit ones are very transactional. There's changes that have happened in banking where that a lot of the banks have moved away from just really deep relationship banking where a business banker might have just a really strong, almost intimate relationship with their customers, to where a lot of the younger bankers are more transactional and they don't really understand credit. So they can't really have a meaningful discussion with their customer. So that dynamic is a little bit different, but a lot of the community banks and a lot of the smaller regional banks still have bankers that are very, very relationship oriented. But the other thing that I'll add is we're actually starting to find a lot of success with wealth advisors and financial planners, because we're finding more and more of them have clients that they're in their late 50s, 60s, they're aging baby boomers that have a lot of their personal net worth tied up in their business. And so a lot of the financial advisors love to bring in a fractional CFO, because that CFO can help get that business to a point that it has value, transferable value, and we can help get a transaction done. And then that wealth advisor now has a pot of money on behalf of their client to invest. So that's a newer dynamic. So the banks are still good, the CPAs are still not, but the wealth advisors are popping up as something that we should all be aware of. Did that help, Jim? Okay, thank you. Anything else before I dive deep here? Okay, so remember, I'm a CFO who doesn't know how to sell. And I stand up in front of this banking group and I tell them, there's 20 people in there, and I tell them the words I used that resonated is I said, I'm building a CFO company. I didn't say I want to do CFO work myself. Now, one thing I learned, and it's more true today than it was back then, is the part-time CFO or the fractional CFO industry is kind of littered with people who don't really want to do it long-term, but they want to do it to do something while they're looking for their next job. So you have to be careful. I've learned you have to be careful how you position what you're doing, because especially today, because a lot of networking contacts have been burned because they have heard somebody give this pitch before about how I'm going to do fractional CFO work, and they make introductions of their, they get to know these folks and they're good people, and they make introductions, and 6 months later, the fractional CFO has taken a job someplace and left the referral contact's client high and dry. So look, that may be what some of you want to do, and if that's what you want to do, that's up to you. You just have to be careful that doesn't help the industry as a whole. It does fill your resume, but all of us that do fractional CFO work and have done it for a while, and Mark and Brennan can weigh in here, being a fractional CFO gives you complete control over what you're going to do and allows you to extend your career. And there is way more security, we all feel, in being a fractional CFO than there is being a W-2 employee. So you have to just kind of get into what your mindset is. Mark, you want to weigh in on that?
Yeah, I really, I say all the time, you'll get your first few clients through your network, but people aren't going to believe you're real until you've been around a year or so, because so many people, this is a transitional position. I'd rather them say I'm just doing some consulting in between jobs than to come out and say I'm a fractional CFO, because it just absolutely.
One of the things that you always want to do when you talk to, let's say, a banker friend of yours, and you explain to them what you're trying to do, and you're trying to be a fractional CFO and work with businesses a day a week or 2 days a week, you always want to ask them if there's somebody else that you should talk to. So you can have that conversation with them. You can explain what a CFO is. does. You can ask them about their customer base. You can do all those things, but you always want to end the conversation with, hey, Brad, I really appreciate you giving me some time here. Hopefully I've been able to articulate to you a little bit about what I'm trying to do. Is there anybody that you know that you think that I should talk to? So that's magic question number one that you ask every one of your referral contacts. Who do you know that I should know? That's magic question number one. Magic question number two is, so let's just say it's a banker, and bankers are out chasing deals. Who is it that gives you most of your leads as a banker? Because if that banker has somebody, let's say it's an attorney, that gives them 2 or 3 leads a year, that's somebody that you want to know. Because my experience is, out of all the people that are out there that are service providers, attorneys, bankers, CPAs, wealth advisors, business consultants, let's say 80% of them are not in the mode of referring, of introducing people to their customers, but 20% of them are. So if you're talking to a networking contact and they can tell you who the people are that are giving them leads, those are people that might be willing to give you leads. Okay. So just think about those two things. Who else should I know? And who is it that gives you leads? And oh, that's interesting. Would you mind? I'd love to meet them. Would you mind making an introduction? And so you set up a coffee or set up a lunch, something like that. Okay. Any questions about that? Because now we're talking about the networking side, which is really not sales. It's really lead generation, trying to find people that can introduce you. Because look, I tried to cold call one day. I've cold called one day in my entire life, one day. And it's like, I'm not going to do this anymore. I don't like being hung up on. I'd rather talk to a business coach that's got 25 clients that are same types of businesses I'd like to work with, or a banker that's got 100. And one of the other things I really like to do with people is, if I've got a banker that I like and they seem to take an interest in what I do, I've actually found that if I can identify leads for them. Hey, Steve, glad we met last week. I really appreciate understanding what you did at the bank. Hey, by the way, I talked to a business owner in town that's not happy with their bank. Do you mind if I make an introduction to you? My gosh, when you give that introduction, they're more likely to give you one back. So anyway, you don't have to have a huge network of people, but you do have to have 5 or 10 or 15 people that you like and they like you, and you meet with them and you're trying to help them and they're trying to help you. Okay. So I was talking about the different ways to do this, and one way is you can do it solo. You're just kind of looking, but just be aware. My comment about, there's lots of people that have come before us and lots of people that'll be after us, and a lot of them, you may want to ask somebody when you meet them if they've had any experience working with a fractional CFO before. Oh yeah, I worked with Julie and Julie was great, but daggone, I introduced her to 2 clients. The next thing I know, she took a job someplace else, and my clients, it made me look bad in front of my client. You just want to be sensitive to that. The way I did it was, I was trying to build a company, and I've talked to hundreds of people around the country that all are like, hey, I see what you've done at Focus CFO. I'd love to get some advice. First question I ask them is, well, what are you interested in doing? Are you interested in doing fractional work on your own? Or are you interested in building a company? And a company doesn't have to be what we have at Focus CFO. I mean, the optimum size, in my experience, for a fractional CFO group is like one main business developer. Again, not sales, a business developer, and 3 to 8 CFOs. That's a nice company. If you've got 5 CFOs and you've been able to get them all work and they're able to bill $200,000 a year and you can bill $1 million and they get paid 60% or 65% and you get the rest, that's a nice way to make a living. So that's a way to do it, but you have to kind of decide what you want to do. And my experience is, so here's the trap. And here's what most people say to me is, well, what I'd like to do is I'd like to start off doing the work myself. And then after I get 2 or 3 clients, then maybe I can add somebody else to my team. Now, that doesn't work very well because what happens is when you get, let's say, a client's a day a week, because it's important, fractional is really a day a week long term. That's really fractional. It's really not project work and it's not interim work. So separate that in your mind, because the other thing you do have to decide is, do I want to do project work? Do I want to do interim work? Project is just I do stuff, there's a defined deliverable, I do it. It might take 5 days a week. It might be 3 months. Interim is somebody lost a CFO and they want somebody to fill the gap. 3 months till they find somebody. Fractional is we go into businesses that are small. They're typically not big enough to have a full-time CFO. We work there a day a week. We have clients. We have clients we've worked at for over 20 years. Day a week or 2 days a week. They pay us whatever, $60,000 or $100,000 a year, and we filled that role for them forever. That's what fractional is. And if you're going to build your own team, and you're going to be the relationship, kind of the face of your company out in the market, you're having 8 to 10. That's what I did. I'm having 8 to 10 to 12 to 15 meetings a week with anybody that would listen. And I would go to an era and I would have 3 or 4 meetings sometimes in the same place. Meet with a banker, meet with a CPA, meet with a financial planner, meet with a business coach. Just telling the story. And I think I brought in 30 clients in the first year. And I didn't work them. I had, as I'm having these 10 or 15 meetings a week, I'm having 1 or 2 meetings a week with people that I had been networked into that were CFOs that were not really happy in a W-2 role, but they didn't want to go out and get to work. So when I'd get a client, I'd start to bring somebody in. Hey, John, you want to join? Here's how it works. And so that's how I was able to build the leverage business. Was I didn't fall into the trap, because if you're working 2 or 3 days a week, you don't have time to go out and build and network enough to build a business to get that new person busy. You don't. You get trapped because 2 or 3 days a week of fractional CFO work usually spills into an extra day just because of things that come up. So all of a sudden, you're trying to take Friday and have a couple networking meetings, and you cannot generate enough momentum. You can find CFOs who want to join you, but you can't get them busy. So that was my experience. That's why I chose to never do it. Now, there are great groups around. So the third option is to join a group. And there are great groups around that run what I call the association model. So if all 20 of us lived in the same town, the same city, we could create a company and we could all come underneath it and we could all be out in the market talking, just trying to get ourselves busy. So you can find a company like that to join. You still have to go out and find the work yourself, but you've got kind of an umbrella over top of you. You can find those. That company will never have real value. And the only way you can make money when you're delivering services is you got to go do the work. I mean, if you're not out at a client billable, you're not making any money. The benefit of the build your company model where you've got you and 3 to 8 CFOs, is you can have an income stream that's passive. And that's how we run the business at Focus CFO is we don't, so we have 160 people and we're in 11 states, but how we operate is we operate almost like a cellular model. So we just opened in Las Vegas. So we have a bit, we call that person area president. So they're out in the market networking and doing all the same things that I did when I started. And then we have 2 or 3 CFOs out there that when the area president finds the work, they don't do it. They allow the CFO to do it. And so in that model, the CFO gets paid a certain amount, the area president gets paid a certain amount, and then we have a certain amount left to run the company. That's similar to building your own company, but it's building a book of business inside of an established business, if that makes sense. So I'm going to pause and I'm going to, again, I could go on for a long time. We've got 20 minutes left. I want to make sure I'm respectful of your time, and hopefully something that I went through may have resonated, but I want to just take a couple minutes and field some questions if you have them, or what's on your mind, or what are you thinking, or anybody want to start?
Brad, this is Jim Lawrence. I
Yes, sir.
just was curious if, as far as the networking goes, have you ever found that just networking with people you know, to say, hey, you know anybody that has a small business and you could introduce me to? Has that ever been a vehicle for you?
Well, that's a great question, Jim. So absolutely, it's a great vehicle. It's interesting. So if you think about some of the people that we know, we may know people in our CFO life that were the bankers, the attorneys, whatever. We may know people in our homeowners association. We know the golf club is a great place to network with people. All of that works. It's really just not being afraid to open your mouth and just tell people kind of what you're doing and to tell the story in a way that resonates with them. So anybody that'll listen, because you never know who they know.
And the
I've got a
strategy that,
question.
oh,
Go ahead, Brendan.
well, a strategy that Brad just landed on that he spent a little bit of time talking about is the investment in the banker, where when you open a door to a banker or to another one of these advisors and bring them in on your deal, I mean, you're going to struggle to outgive that person in the future because there are so few people that are actually reciprocal in how introductions happen. So you immediately distinguish yourself from 90% of the other people that look just like you that may have networked with them, had a coffee, and never done anything for them, just expected business to come flowing in the door. But by, you doing something to help them, you've immediately set yourself apart. And that does a lot in terms of building that foundation for a long-standing, highly profitable relationship. So Mark Green, it's all yours again.
No worries. Thank you. So Brad, as you talked about regionalizing and going to Vegas, and I guess, you're in various parts of the country, how are you adapting your model, I'll say the economics of your model, for the different regions that have very different cost structures, right? Ohio is going to be very different than Southern California or New Jersey or San Francisco, for example, in terms of CFOs. And so are you adapting your billing rates? Are you adapting your overhead rates? How are you adapting?
That's a great question. So and I can take this offline with you if you want. We have pricing that we know works in the Midwest, and we price off of monthly retainers. So we don't do hourly and we don't do day rates. We say if we're going to be there a day a week, we're going to charge $6,000 or $7,000. When we go into a higher cost area, we're always looking to adjust the pricing to what market is. We don't adjust the overhead rates. It gets too complicated, but we found that when we can adjust the pricing, then we can get the economics that we want.
if you adjust the pricing, then you're essentially, if you're keeping your rates the same, then you're bringing in more on those higher cost markets for the similar overhead because your overhead's based in a lower cost market. It just
our overhead's pretty much all over at this point, so
is
it's
it
not
okay?
just here; it's pretty spread
Okay.
out. Yeah, but thank you for
Okay.
that.
All right, thank you.
But so if you're thinking about building your own practice, one of the things you have to think about is what are the economics? What are the economics? If you're going to go again, if you're just going to build the clients yourself, then you're going to get and keep. Everything you build, you're going to keep. If you're going to build a scalable organization, you're going to have to figure out what the economics are. How much are you going to compensate the CFOs? How much are you going to budget for your own overhead? And one of the challenges that I had is, look, I was making it up as I go. So it got to a point where you're trying all these things and you don't know what works. And I spent $12,000 getting a contract written. I think we're on like our 8th website, but I'd spend $6,000 or $8,000 on a website and $12,000 on a contract and $10,000 on this marketing thing, and it didn't work. And I found out I had to hire an admin person. I had to get liability insurance. So life got complicated when I started adding people to the practice.
Wow.
Look, and there were years when it's like I'm putting in way more than I'm taking out. And there's years when it's like, I'm not sure this is going to work. And there's years when it's like, oh, this was a whole lot more fun when it was me and 4 people and I could control it versus trying to build an organization. We went to Cleveland and wasted $250,000 in the first try. Didn't work. And so those are just things that you kind of have to decide what you want to do. And you can stay in your home market. I mean, I wouldn't recommend anybody try to bootstrap Focus CFO like I did, because I was using all my own money. You can do that if you're partnering with a private equity firm or something these days, but they're harder to work with. But within your home market, you have to figure out the economics. How am I going to find the CFOs? How am I going to bring them in? How am I going to compensate them? What kind of contract am I going to have with them? Because you don't want them to come and you get them a client and all of a sudden they take the client and steal it from you. You got to work through all those issues. But all those things are doable. You just have to be willing to invest your own time and money in building something that's scalable. Or you can look to join if you want to either do the CFO work or you want to build something that's a kind of a scalable passive income stream. You can look to do it inside of another organization. That's what we do. There's some other ones that do. B2B is a great firm. A lot of you have heard of that. They run the model where you come in, join their brand, but you have to go find the work and do it yourself. We run the model where we have people that find the work and then people that actually do the work, which allows people to stay busier and probably get busy faster. But they're all great options.
Richard, you raised your hand.
Yes, Brad. Yes, Brad. Thanks very much for your discussion. 2 things, Brad. Firstly, could you please give your opinion on if the importance you place on a fractional CFO specializing in a specific sector, for example, niching? And secondly, regarding your model, my main concern with your model is generating income in that first year, because one would really have to make sure that you can get clients for your CFOs. If you could just comment on that, please. Thank you.
So thank you. So the first one about specializing, I'll let Mark jump in on this too. And Brennan, we don't find that there's much of a need. If you're an experienced CFO, you can walk into almost any different type of industry, and the learning curve is not that steep. Now, maybe if you spent your life doing construction, manufacturing there might be a learning curve on that. But oftentimes we don't start with the nuances of the business. We start with the dynamics of what they're trying to accomplish. So do you need metrics? Do you need KPIs? Do you need a smooth monthly close? Do you need a budget and forecasting process? Are you trying to build value in your business? And I do have people, Richard, all the time that say, prospects that say, well, you have somebody that knows my industry? And the answer is, well, maybe, but you know your industry. And how about if I bring you the best business person that I've got? And you can learn from them and they can learn from you. And that 99% of the time, that's successful. So does that answer the first question?
Yes, thank you.
So the second part of the question, it's not so much unique about our model. It's whether you're doing it on your own or whether you're joining an organization, there's always going to be a ramp up, always. Because there's nobody I know of that has a supply of, hey, if you join an organization, there's immediately 5 days a week of clients. Because a lot of what we all have to learn how to do is we have to learn the difference between being a great corporate CFO, where you're working in the same place 5 days a week, and the org chart actually already had CFO on it, and somebody was your predecessor and somebody will be there after. We have to learn how to become a fractional CFO. And when you're only someplace a day a week, it's just way different than, and you probably don't have an office, and they don't really know what you're supposed to do, as opposed to the traditional role. But there will always be a ramp up. If you're doing it on your own, the ramp up is dependent upon you and the effort you put into it. If you join an organization, and again, it depends on whether the organization has a business development process. Like Richard, over in the UK, the FD Center is huge. And we know those guys well. And I've been to the UK, I've been to their conferences. They're tremendous. And they run a similar model in Europe to what we do in the US, where they call them regional directors to go out and find the work. And then they have FDs, financial directors, that do the work. That person that's doing the business development already has a network. They probably already have some prospects. Your ramp up will be faster inside of a group like them or us than it would be on your own, but there will still be a ramp up, if that makes sense. That makes sense. Richard, did I answer your questions okay?
Yes, and just finally, regarding your CFOs, what I am interested in is, do they, whatever the project is that the client needs done, do you have standard templates, or do you leave it to the CFO to do the work as and how they decide to do the work?
Great question. The answer is both. Both. What we find that very, very talented CFOs, like all of you are that join organizations, actually know what to do, and you have a way that you've done it. Now, we provide a framework, and we say we know how to retain clients long term because we've been doing fractional for 22 years. We're going to teach you how to do that, and we're going to teach you a framework to work within. And we have tons of templates if people need them. But what we don't do is say, forget about how you've already done it. Here's our way, and it's the only way to do it. We would never do that. And you should never go to work for an organization that's going to harness you like that, because you're all too good. What we say is we provide handrails, not handcuffs. So here's the framework, here's the lane. If you need some help, there's 150 of us that can help you. And go into our resource center, there's tons of stuff. Post something on Teams, and 30 people will reply and say, can I call you, or I'll call you, whatever. That is really positive, but we're not going to bootstrap. Bootstrap's not the right word. We're not going to handcuff you and say, you have to use these templates. Now, I'm not sure how the FD Center works. I don't think they do that at all. I think they're very similar to us. Mark Green, who had their hand up? Mark Green, do you have your hand up?
Green.
Yeah, I do again. Couple of questions came up. So 2 questions. One is, first one is, how is your turn rate with your CFOs? Are they staying with you, or are they using you as a bridge to get on their own without taking your clients, obviously, but just to get some some ground under their feet, if you will? Is this first question. And second question, are you still focused on, I think you said the under 50 million, maybe in that 2030, or have you expanded above that? And if so, what distinctions do you find?
Oh, great question. So one of the things that what we do is we're trying to figure out, because when people interview with us, they say, "Oh, I love it. We love what you guys do. We want to join." In the early days, I would just bring people on and just find them clients. And then as what I found was exactly what you just mentioned, was they would leave for something else, or they'd try to jump on kind of one of our clients. So I started charging them money to join. And that's really complicated, but it can be simple. It's just a licensing thing. But so we charge people $8,000 or $9,000 just to join. That actually weeds out the people who actually don't want to do it long term. And we don't care about the money at all. We just want to know who's looking to do this long term. And we're very particular with people about going. We don't want people. We want this to be the last thing people do. And every once in a while, one of our clients will want to hire the CFO, and they have to pay us a fee, but we work that out. But I mean, if we've got 100, Marcus, what do we have? 120 CFOs at this point, we might lose. Is that about right, Marcus?
Yeah, it's close to 130. But
130. So Marcus is over recruiting. So if we have 130, we might lose 5 in a year. And there might be a couple people that we just flat out miss on. That we just miss on them because we didn't think that they had a W-2 mentality, but they do. And they're just not comfortable with the ramp up. We have a few people retire. We probably have 1 or 2 people a year that our client needs to hire them. We work them out, but we don't have that much turn. In terms of the revenue size, we just started a client in Columbus that's going to do 71 million. They did 15 million of revenue last year. They're going to do 71 this year, and 220 next year. The issue is how long can you support somebody like that working 1 or 2 days a week?
Yeah, at some point they need more.
Yeah, they need more. Now, we've worked with people that were up to 300 million of revenue. Very simple business model. Kind of do one thing. It's very process driven. The business is really simple. We just find that there's a point kind of between 20 and 50 million when most businesses, we're just charging them too much money. I mean, if we're charging somebody, $15,000 a month for 2 days a week, it's 180,000 a year. We're probably going to go to them and say, look, we just don't think this is the right solution for you. We want to help you find a full-time person, and they pay them $300,000. And it's just a better thing for them to do. And we want to bring that to them before they come to us and say that they think they need to hire someone.
One last question, and then I'll let it go to Bruce.
Okay.
Do you feed, sorry, well, I guess it's feeding. Do you have enough business to feed your CFO so they can be just with you, or do you find them in multiple groups because they need that to get a full plate?
We can keep them busy. Now, if we're in a brand new market like Vegas, the ramp up might be a little longer because we only have one area president there. If they join us in an established market, we can say, well, we'd take 5 more people in Columbus right now, or Cleveland if we could find them. It's just hard to, there's a lot of people that want to join, but they just have to be the right level of person. But we tend to get them busy. We don't want them being involved with other groups because it actually confuses the market.
Sure.
Because if they're out saying, well, I'm part of Focus doing, working with them, and I'm also doing it on my own or with another group, it just doesn't look good in the market for us. So we put all of our resources into getting them busy.
All right,
as quick as we
we're
can.
running low on time. Bruce, one more question.
Sure. How do you, with the retainer fee schedule, like how do you manage the expectations of the customer? Because with the retainer, would they not expect, more than, say, if you say had 1 day a week, all of a sudden, next thing you know, they want them or expect them 3 days a week. Like, do you adjust it then, or how do you manage that?
And retainer may not be the right word. It's not like a law firm retainer where it's kind of an advance. It's advance on whatever the bill turns out to be. We just tell them a day a week is $6,500, and we're going to invoice half of it on the first day and half on the 16th of the month. And we actually ACH pull out of their account. We don't send invoices to anybody. Now, we're big enough that we can do that. If you're brand new, that might be, you might just find it easier to do a bill. But if we find that the time gets to be more, then we'll tell them we need to adjust the billing amount. But we don't want the billing amounts to go up. We want to stay in a lane. We want to keep it affordable for people. And sometimes it goes from a day a week to 2 days a week. Sometimes it does. But we're talking about more, it's not what you need, it's what you can afford. And we'd rather keep the baseline billing at a set amount and kind of work at a slower pace, which is, this is one of the big differences between working fractionally and working full-time, because when you're full-time, you want to go in and you run at every problem as fast as you can, and you try to fix it all as fast as you can. That overwhelms these smaller organizations. We're usually working on 2 or 3 initiatives a quarter, and that's it. But our list, we might have 20 things on the list that are wrong. We sit down with the business owner and prioritize and say, we're going to work on these 2 or 3. Sometimes we'll step it up and say we'll go to 2 days, or we'll increase the monthly billing, but not that often. Not that often.
Okay.
Now we're out of time. And I know if there's some other questions, look, send me a LinkedIn message. I'll do a one-on-one with anybody in here. Marcus or I, Justin's on our team. We'll be happy to talk to any of you about anything. And, we're just really committed to having the industry be a success.
I learned so much, Brad. That was fantastic. Thank you. I have to rethink a few things. I absolutely agree. It's hard to do the work and sell it too. That was sort of an eye-opener in a way for me. So I'm going to give that some thought. But I really appreciate everyone's participation here. And we'll close up the meeting. But if people want to stay around for a few more minutes, maybe we can talk a little more. But we're officially dismissed. So.
Well, and I would like to throw in one thing for anyone that has questions about marketing a fractional business. We host another SBMO on the second Tuesday at 3:30 Central Time. So that one, we're happy to have anyone, and we spend a lot of time talking about networking and referral relationships and leveraging social media to secure fractional work. So I'll throw that out there too.
Look,
Yeah.
in their program, Freeway to Fractional, if you're thinking about doing this on your own, go through their program. It's not very expensive. It's definitely worthwhile. You'll get a huge amount of information and time, and you'll be able to decide. Look, information leads to ideas. And whether we read a book and get an idea, or listen to experts like Mark and Brennan, go through it, and you may decide, if you go through it, that the business development stuff is not what you want to do. Or you might go through it and say, well, this isn't bad. This isn't selling. It's just having a bunch of friends that you play golf and eat lunch with. That's all it is. And you might like that more.
Coffee for me, happy hour for Mark. Yeah.
And I'm happy to I will tell anybody how to build a fractional CFO practice. I'll tell you exactly what you need to do. I'll tell you exactly what your contract needs to look like. I'll tell you exactly what your marketing needs to look like. But I'm also going to tell you, you're going to probably spend $25,000 to $75,000 over the first couple of years just on stuff to make yourself look real. But look, it can work. Or you can say, hey, maybe I want to join a group like Focus CFO or B2B because it's better for me. Again, it's just, we're all different. There's no one solution for everybody. And I'm happy to stay on for as long as anybody wants, if you want to keep talking this evening.
I appreciate it. Thank you so much. Thank you, Brendan and Mark. Thank you, Brad. It's been informative. And again, I will echo Brad's comment on Freeway to Fractional with Mark and Brendan.
Yeah, if you really want to know the step-by-step process to building a CFO, a fractional business, not only as a finance, but as across the board in different services, check out our LinkedIn website, Freeway to Fractional, and contact Brendan or I anytime.
Okay, everybody. Thank you. Bye-bye.
Thanks, everybody. Again, feel free to reach out. Happy to help.
Thank you. Will do.
Richard, check
Thank
out
you.
FD Center. Seriously, they're really good people. Colin is a really, really top shelf guy. Okay.
Thank you very
Okay.
much, Brad.
Sure.
All right, we're dropping off.
Thank you, everybody.
Thanks, everybody.
Thank you, everyone. This was great, Brad. Appreciate you.
Okay, no problem.
Thanks, Brad.
Thanks for the offer. Okay, to join. Thanks, everybody. Bye-bye.